make a move when all is said and done. We want to bring in John Hilsenrath. He is the Wall Street Journal's chief economics correspondent, and he joins us right now in D.C. Good morning, John.
Good morning, Maria.
Tell us how you think this meeting plays out next 2 days.
Well, you know, the Fed has a puzzling economy to look at. On the domestic side, the U.S. economy looks like it's in pretty good shape. We had decent retail sales numbers yesterday. The job market is creating jobs. What they're worried about is the international environment and the markets. They're worried basically that the markets are sending a signal that the outlook is changing for the worse. You know, when it comes down to it, I think the one fact that I think that makes the most has the most meaning to me is, and this is a kind of weird fact, Janet Yellen likes to get to the airport 3 hours early. She likes to have all of her ducks lined up. She doesn't like surprises. I think in an environment where there's so much uncertainty about how to proceed, it's going to be hard for her to proceed because she doesn't like to surprise people.
That's funny. She likes to get to the airport 3 hours early. So you don't think she wants to surprise people, meaning, so you think that she will raise interest rates, or because in the last couple of months the market expectations have changed?
Well, that's the point I'm trying to make, is that the market is not expecting a rate increase
anymore.
You know, in futures markets, it's around 30%. It's hard to see how a person who doesn't like to be surprised herself would turn around and surprise the market. And that's why I think it's going to be tough for them to move tomorrow.
Wow. So now you don't think they are going to move on interest rates tomorrow. Marian Bartels, you think they are, but it's a debate given the economic data out there.
It is. The economic data supports it, especially the labor market. We think they just want to get off emergency zero bound and just get liftoff and then see how everything is absorbed, but do it very conservatively in terms of raising rates. We're saying every other meeting they may possibly raise by 1/4 of a point.
Wow. I don't know about that in terms of the Labor Department, though, because, Wilbur, you just made a really important point during the commercial break. Talk to us about what you see happening in the jobs market right now.
Well, to me, the biggest concern is labor force participation. Only 62% of working age people are in the workforce. That means 38% neither have a job nor want one. And what does that in turn mean? It means every 3 people who are working have to lug along 2 people who are not. That, to me, is the most fundamental problem keeping this economy from going at a faster rate.
John, that's an amazing stat. 38% of working age people either do not have a job and don't want one.
Well, you know, and the problem for the Fed is there's not that much that they could do about that. You know, they can cause more consumption, but they can't force people to come back into the workforce. And then, of course, on top of all that, we have an aging population, which is moving into retirement ages, which just increases that dependency ratio.
Yeah, the aging population is important, but nobody is as bad as international. I mean, we're not as bad as what's going on in Europe or Asia, right?
Absolutely true.
Yeah.
Absolutely true.
Joe, this participation rate has been something we focus on every month when the jobs number come out.
Yeah, and it's been persistent, right, over the last year and a half. It really hasn't moved all that much. You couple that with wage growth not really picking up steam, and that certainly is a big red flag that just continues to wave for Janet Yellen. It's persistent, and that's something that, you know, as the job numbers continue to hike, it's something to balance as you look at the broader economy if people will consume. And consumer confidence, retail sales, disappointed, even though they weren't that bad, John Hilsenrath, they did not meet expectations.
Right. John, I mean, the reality is this. The other reality is that the international community has slowed down quite a bit. John, is that why the Fed's plans changed? I mean, we know that the Fed wants to get off zero, but has the activity in China, the emerging markets, Europe, changed the game for the Fed?
Absolutely, in part because what it's done is it's pushed the value of the dollar up. So the currency markets have already imposed a tightening of financial conditions on the U.S. economy. When the dollar is stronger, it makes our exports more expensive, harder to sell stuff overseas. It also puts downward pressure on imports and imported inflation. And because of that, the Fed is looking at a financial environment that's more restrictive today than it was back in June.
Yeah, I mean, that's what I've been focused on recently, Wilbur, Ross, and the reason is because you have to ask yourself the question, with Japan in recession, Canada in recession, Europe slow, emerging markets still unable to get out of the funk, can the U.S. show growth, sustained growth, when all of our trading partners are challenged?
Well, we're relatively less dependent on exports than most of the other countries. Germany is probably the most dependent on exports. China is very dependent. We're not so much. We're a very big domestic market. And as you know, we have a negative trade balance in any event. So I think it's easy to overblow the importance of exports to the United States.
I realize the markets have been rallying on this idea that maybe the Fed will not raise rates. That's what you were saying earlier, John, right? Is that why you're seeing that the markets rallied yesterday? The futures are showing that the majority does not expect a rate increase. But I'm wondering from you, Marianne, if the Fed doesn't raise rates tomorrow and announce that increase, does the market sell off because investors figure out, you know what, this economy is a lot worse off than I thought?
It can go either way, right? What we've been telling clients is that we expect continued volatility. We're in a very seasonal weak period for the markets. September is one of the worst performing months, but we make very important bottoms in the month of October. We think the risk is that you test the recent low. You might even make a minor new low. But this is another major buying opportunity for investors that either want to, rebalance their portfolio or have been sitting in cash, because this is the first 10% correction we've had. It's a little bit more than that,
yeah, 12.
But it's the first 10% correction. And what our clients keep saying is we want a correction to get into the market, then the news is really bad, and then we have a hard time getting them in the market. But we think if you do get another sell-off in the market, you should be aggressively buying equities.
Are you on the other side of that trade, or you want to buy stocks here, Wilbur?
Well, we've been selling much more than we've been buying over the last year, maybe 5 times as much selling as buying. Not because we think it's the end of the earth, it's just that things are not so cheap anymore. And we think there are some times when it's better just to hide for a while. So we're going into a little bit of hibernation.
A little hibernation in the U.S. Same with international?
Well, we've been doing a little bit internationally because there you've had some dislocations. The China particularly, I think, is trying to get very interesting.
Absolutely. John Hilsenrath, final question for you. If the Fed does not raise tomorrow, you think it happens in December, or maybe not then either because we're data dependent?
Well, you also forgot to mention October. I think
but
what
there's
you
no
have to look
meeting
at,
in October. There's no press. There's a meeting, but there's no press conference. I made the assumption that Janet Yellen does not want to raise rates and not explain it in a press conference, which is why I said December.
I don't think you can make that assumption.
Okay.
I think that you have to look at 2 things tomorrow. You have to look at the action or the lack of action, and you have to look at the signal. If they don't go tomorrow, then there are going to be a lot of people in the room who want to go, and Yellen is going to have to give them something. And I think what she's going to have to give them is a signal that they still expect to move sometime this year, because the domestic economy is strong, it is improving, the job market is improving. So I think the signal we get if they don't act is that we're still likely to get something either in October or December, as long as these threats that we've been talking about don't become more serious.
All right.